Welcome back to How to Invest in Commercial Real Estate. We are back.
2023.
I know. I mean, we've been, when did we start the podcast? 2021? Like November, I think?
Yeah, late 21.
So it's been a long time coming. And, you know, it's exciting. We had an insane year last year. And I think today we just wanted to go back and kind of do a spotlight on 2022. And then maybe at the end go into what we're thinking for this year. So we did a ton of deals last year, right? Like I think we bought 10 and we sold 4. So more than a deal a month, a lot of activity. Obviously couldn't have done any of this without our investors. So massive thank you and shout out to them. We had a ton of new people get involved this year on real estate, right?
Yeah,
like
the investor list continues to grow.
Yeah. How many new investors did we get on our list in 2022, do you think? You have any idea? Over 100 maybe? Or?
Easily 100, easily 100. But I think out of those 100 new people that invested with us last year that haven't invested before, there's easily 25 people, I want to say. I mean, at least 2 brand new people every single deal, which is just amazing, right? Because that's why we're doing this, is the testament to get people involved in real estate. We found amazing.
We're doing it to make money also.
Yeah, we're selling you a course.
Well, we'll make you money while we make money.
Yeah.
Isn't that a fair trade?
I mean, win-win.
Anyway, so thank you to you guys for listening and being part of Criterion. And we're just going to go through. So we started off the year with a bang. And in January, we bought Plaza West. It was $7.5 million acquisition. So I personally love Plaza West.
That was probably our biggest deal to date, right? At that time, was it?
That was the biggest deal at the time. Biggest deal to date. Yeah.
It's been a huge home run.
Massive home run, right? So we bought this massive shopping center, had 3 out parcels in front of it. We've talked about it a lot on the show. We were able to successfully close those out parcels as well as distribute cash flow all year. And the investor IRR is ridiculous on that. And they got 100% of their money back. And we still own most of the shopping center, and it's still cash flowing and it's still paying down the debt. Massive home run on that deal. Not too long after that, I think it was in April, we bought Gordon and Farber. And that was
And Marketplace, or are they
Marketplace Commons was like a month later. But yeah, both of those together we combined in the St. Louis Retail Fund 1. So that was going great. You know, we knew we had a decent amount of CapEx work that needed to be done initially, you know, some roofing, some sidewalks, some parking lots, stuff like that. But that one we actually walked into, we had several tenants immediately kind of non-default, a couple that we're struggling with just getting them on our payment schedule. So that one wasn't the best this year, but we're optimistic for 2023, and we've got a decent amount of vacancy to fill. And that was the plan with that asset really all along.
Yeah, I'll just make a note that out of 10 deals, I would say that 1 or 2 is probably been the toughest deal. And so I just remind investors, we haven't lost anybody's money, but there's always that chance that deals won't go the way we want them to. This is an example of a deal that hasn't gone anywhere close to the way we wanted it to, but it still is servicing the debt. We're still positive cash flow, and we've had a lot of vacancy. If we can fill that vacancy, we're going to be, you know, back to paying distributions. It's just an example of a tough deal that isn't losing money, that isn't losing investor dollars, but it's been a struggle.
Yeah, and I think that goes back to our original pitch, right? Like we want to find investors that don't have an investment relationship of $100,000 and they give it to us one time. You know, I want a relationship with somebody that can give it to us 5-10 times a year and try to be in every single deal. We try really hard not to cherry pick ourselves and deals. I mean, we're in every single one of them for this reason, to help mitigate risk and diversify. Next one, we bought another Kiddie Academy in Cypress. Normally our Kiddie Academies are ground up construction. But this one, we actually bought an existing Kiddie Academy. Joel can't even silence his freaking phone.
It's silenced, just vibrating.
Anyway, so we remodeled this Kiddie Academy. We plugged a new franchisee in there. We were able to get a 15-year lease with annual increases on that. And we actually just sold that right before the end of the year. They signed the contract the day after Christmas. They closed 4 days after that, $4.25 million in cash. Fastest closing I've ever seen in my life. Fastest closing our partners have ever seen in their life.
How'd that come out based on projections?
Based on projections, I think that deal had like a 50% IRR. So we bundled that deal and the New Jersey Kiddie Academy, which is next on our list, together. So overall, that deal was a massive success. And again, I don't know if I said this or not, but we did it twice as fast as we originally projected. So I think that one, we were supposed to hold a year, and we bought it in June and we exited by the end of the year. So obviously a taxable event there, but when you make money, sometimes you have to pay taxes.
Yeah.
All right. Next one, Kiddie Academy in New Jersey. We did the exact same thing as Cypress, right? We bought a failing Kiddie Academy. We shoved in a new operator in there. We spruced up the place, new 15-year lease that is currently on the market for sale today. As soon as that sells, it'll get the investors the rest of their money back
And the
profit as well. That one, I think we were supposed to hold 18 months, right? Bought it in July.
Yeah, so it's only been.
We've already been under contract once. It fell through,
Yeah,
which is
it'll
kind of
be
typical.
exited within the next 6 months.
Yeah.
Yeah,
sure.
which just boosts the IRR a ton. I think that one will probably end up with a 30-40% IRR pretty easy after it's all said and done.
Good.
Which is amazing, right? Like, when's the last time you talked to somebody, how's your stock account doing? Man, I'm up 30%.
Yeah.
Yeah, stock markets were down 20% across the board for 2022.
Yeah.
The worst year for stocks since 2008.
Ooh, that sucks.
Yeah, that's bad.
All right, next. See, this one is fun. This one's fun. Stonewood Village. I'll never forget. We were sitting at Smoke, eating lunch. We were watching this auction. We're bidding on a property.
Never
in
seen.
Stone Mountain, Georgia. Didn't you and I fly out there, or was that after the fact?
No, that was after
That was
the fact
after,
for
yeah.
sure.
Oh my gosh, we're insane.
Yeah, we bid and won. Well, we didn't actually win the auction that day, but we were bidding on it without ever having seen it.
Right. And then they call us the next day and we're conveniently the winner. You know what I mean? You never know what it is with these auction platforms. Anyway, we signed the contract the day after. We wired them $600,000 the day after that. Me and Brian hopped on a flight because Joel's in Cancun probably or something.
No, I was not in Cancun. Well, actually, depending on when this was.
Might have been.
It's like August.
No, I wasn't in Cancun.
No, it wasn't in Cancun. You had to think
Why?
Anyway, Stonewood Village has been kind of a secret success, right? All of the tenants have stayed. All of the tenants are current and are paying rent. We've had tons of early renewals. Little Caesars just reached out a year and a half before their lease expires to renew another 5-year option, which is just a testament to how well they're doing now. They're saying, man, we have to exercise this option as fast as possible. We have to lock down this location for another 5 years. We had that funny car crash. Somebody drove through the building, so we got the insurance settled on that. We lost a few $1,000s, which is negligible. I mean, it was $30,000 worth of damage. But overall, we've got a property that's not leaking. We've got a property that's in good condition. We've got a property that's paying us great cash flow. It's got tons of money in reserves because we haven't had to spend anything really on capital expenditures.
Overall, solid.
Yeah, if anything, that's gone to plan or maybe even better since we didn't have any surprises.
No surprises, I would say, is better than planned.
Yeah, right.
It was a good deal, though. Good deal. The next one, right? Trying to top, we set a goal for $60 million in acquisitions. So we knew we had to do something big. We got presented an opportunity with the guys in Fort Worth, the Woodmont guys, to buy a deal in Slydelle, Louisiana, which is, again, a little out of the comfort zone a little bit. But they had a great relationship with several of these big box tenants to where they were just calling their senior real estate guy on the phone and saying, hey, would you renew at this location? Yeah, I would renew. That store does great. Here's financials, what have you. We had an LOI, I think, while we were under contract. That tenant got moved in. And the big value add for this place, sure, it's a big box center and it's an 8 cap or whatever it is. It should cash flow fine with the debt we had on it. But the real value add, the real heavy lifting was those out parcels, right? And one of those were under contract with a car wash to buy one of those. And that's over $1 million in sales proceeds right there. It'll probably pay back a third of the equity. And the beauty of that deal is when we set up the loan on the shopping center, we had them specifically exclude the out parcels from the value. So we get 100% of those sales proceeds. So now the cash on cash will go from something like 11%, what it's been paying the past 2 quarters, which is what I would consider a great cash on cash return. Now that'll probably go up to like 15%, right? Yeah. So massive win.
So, and that we think that might happen Q2 based on the LOI, right?
Yeah,
we have to go and get the lot split. They have to go and get permitting and
there's like 2 or 3 other out parcels.
There's 3 left.
Yeah, so that could end up being a really massive home run.
Fantastic.
I agree. Yeah, massive deal. And that set our record purchase price for the year, largest acquisition to date and last year of $12.5 million.
Yeah, that was a big one.
Massive deal. After that, these are my favorite because it's in Owasso. So the next one is at 96th and Garnett. It's a really busy retail corridor of Owasso, Oklahoma, which is part of Tulsa, just north of there. And this is a retail development. So the story behind this land is it was owned by this family forever. They sold the majority of the land to develop the JCPenney, the Best Buy, this massive 250,000 square foot power center. And she refused to sell the rest of this land, even though it was just an amazing location. There was a barn there. And literally as soon as this old lady died, the land sold and it's now immediately developed. Everyone was kind of waiting for it. But anyway, we put in a Salad and Go. We're developing a Salad and Go. We're developing a 5-tenant strip center next to that Salad and Go. So I think it's probably a $4.5 million development cost on that. We put around $1 million in equity into it, and the building should be complete by the end of the second quarter next year, and hopefully sold by the end of the year next year. We did that again. So on the other side of that lot, there's Chipotle. On the other side of that Chipotle is this hard corner, 30,000 cars a day.
Who doesn't want to be next to a Chipotle?
Yeah, that's perfect.
Seriously, Chipotle, Chick-fil-A next door. There's a Hawaiian Brothers. I think. Anyway, Chipotle is a great location. I mean, the Chipotle has literally had a line out of the parking lot into the street backing up traffic because Owasso doesn't have a Chipotle. It's mind-blowing that we haven't had a Chipotle, but now we do. Amazing location. That one is a lot easier deal. We're doing 2 ground leases. And people really aren't familiar with ground leases. I think Joel, explain, I guess, in the layman's terms, as easy as possible, what a ground lease is.
It's really easy. You have some land and you have a restaurant that wants to go on there, or it could be anybody, but you do a lease like you do a normal retail lease, only you're just leasing them the ground. They can put whatever building they want. Maybe you have approval rights. So they construct a building on your land, but you're just leasing them the land. If they ever go out, then you own that building too, because that's permanent fixtures that they put on your land.
So if they break the lease or don't want to renew the lease, then
you get the land back with the improvements.
Yeah, great.
The building. It's pretty crazy. So in this case scenario, we have to deliver a pad with utilities on it. So we're going to do some dirt scraping. We're going to get
what are those
utilities.
2 tenants?
Taco Casa, and then the other one is still under LOI right now, so we can't release that one. But it's going to be another fast food place, ground lease fast food place. So 2 ground leases. We'll exit those. We'll deliver the pads in the first quarter, most likely. They'll probably have the building up by the end of the second quarter, maybe end of the third quarter, and they'll probably sell before the end of the year next year.
Yeah, good news. We got the Taco Casa lease signed, today or yesterday?
I got it. Yeah, I got it signed today.
And
nice.
And then they've got a lot of interest on the remaining space. So
there was a lot. I mean, and there's a lot of bigger brands that are kind of teasing us a little bit and throwing their weight around of like, hey, of course you want this. You need to give me the timeline I want. And I think we're kind of playing hardball with them because we've got other great tenants that are willing to sign and pay great rent. So I don't really care if there's this amazing brand that wants to play hardball or somebody else who wants to pay me rent.
Yeah, we're in a good position on those.
Yeah. So we feel good about that. And that was actually a start of a brand new relationship for us. So we've done a lot of deals with the Woodmont company now, I think 5 or 6, maybe 7. And they introduced us to another company called Retail Partners. That was our second deal with them. We're looking at several more deals with them. We'll most likely have several in 2023 with them.
Yeah, for sure.
Been a great group of guys.
Right.
And then the last deal of the year, I think we closed this on December 5th, was a small gym deal in Owasso. So small 2-tenant gym deal. It's being fundraised right now. It went up on the website. It was a super small equity raise. That and the last 2 Owasso developments. So if you hate us because you didn't get in, I'm sorry. I mean, it sucks, right? Like, we have to fund this deal. We know $1 million isn't a massive equity raise for our investor list. It sucks. The last one sold out in an hour. I hate getting a phone call from the guy 2 hours after I launch it saying, "What the heck, man? It's full."
No, he doesn't hate getting that phone call. He loves filling that up in 1 hour.
He actually gets a lot of those calls.
But people get frustrated, right? Hey, you just sent me this email 2 hours ago. What am I supposed to wait at my computer for you? So,
it's tough. We have a lot of investors. We can't accommodate everybody, and it's just the nature of the game that those that are most interested, that trust us, that have been in deals before, are going to pull the trigger faster than certain other people. Yeah. And it's not that we don't want to let people in. It's just
it's really you not wanting to let people in. It's all your fault.
We want to find more deals. We found a lot of deals. This didn't even include the precision equity deals that I was involved in. So there was a lot of deals done in 2022. I think the 2023 deals, just to talk about that. they'll look different. There won't be as many cookie cutter multi-tenant retail deals that we're buying at 8 cap and getting debt at 4%. We're going to maybe look to do a lot more development partnerships because the market is still pretty good. But getting long-term debt with sellers that are unreasonable on their pricing expectations is going to be a little tougher in 2023.
Yeah, developments seem like they haven't slowed down, or maybe it's because we're relatively new on development and it's becoming a bigger part of our portfolio. But
well, I think the development you have such a short holding period, and the arbitrage is the lease, right, that you're selling. So it can support the increased carry costs of the debt, right? Whereas the long-term cash flowing property, it can't really support the extra debt costs because it's cash flowing. So I think if you do see a retail deal, which I'm sure the probability of us doing a retail deal next year is pretty high, but I would say in the short term, you're going to see us underwrite 2 to 3 points lower cash on cash until we can get that rate refied. Yeah. Obviously, we believe we can get a rate cheaper than 7% or whatever the heck it is right now. So you'll see us, hey, here's year 1, 2, and 3, not amazing. It's really shitty debt. We understand that. But year 4, here's what it looks like with great debt. Here's what it looks like with January 2022, 4%, amazing. You can buy whatever you want debt.
Yeah, predictions that I have for 2023, I believe we'll see sellers starting to adjust their cap rates, maybe by second, third quarter of this year. So before, where rates went up so fast, sellers were holding. Now there are going to be some sellers that need to sell for whatever reason. So we'll start to see some of that adjustments. We'll look forward to trying to take advantage of those deals.
Absolutely.
I think some of the word that I'm hearing, Joel, I don't know if you've been reading up on this, is that late 2023, maybe Q4, that maybe the interest rates start leveling off and maybe start tinkering down just a little bit. So,
I agree.
Yeah.
I mean, what I would say is, on the Criterion building, that interest rate is slowing because we believe long-term rates are still have the possibility to come down in the short term. We think we can refinance that asset in Q1 or Q2. So I think
of 2024, maybe.
No, I mean, yes, but maybe earlier. Yes, but maybe
Q1
earlier.
of like this year. We're in Q1 of 2023. We're not thinking about.
I think long-term interest rates are coming down at the end of the first quarter, probably.
Okay. We'll see.
We will. So we'll have this on video.
Yeah.
Yeah. It's documented.
Well, good. I think it was a good run. We look forward to 2023. Hopefully, you guys listening will make a commitment to get involved in commercial real estate in this coming year.
Absolutely. Well, that is it for this episode, and we will catch you guys next week on how to invest in commercial real estate.